Investors, if you watched markets over the years, you've heard this phrase time and time again. This time, it's different. Today, the headlines may feel heavier than in the past. We're talking about war, oil spikes, political uncertainty, and AI disruption. May feel different. That said, investing on one's feelings and emotions is usually a really bad recipe for outcomes. Investors, is it actually different, or does it just feel this way? Are you possibly letting your emotions drive your decisions? I'm going to walk through the data in this episode. The markets price uncertainty quickly, albeit not perfectly, but efficiently over time. War headlines feel very extreme, but markets most often adjust faster than one expects. Short-term volatility is normal. Long-term returns follow earnings, innovation, and interest rates. Every stock market correction has a new reason, but the pattern more than often repeats. War and markets. Let's go back in history and look at major conflicts and wars and how stocks have performed the first year of each war. Let's go all the way back to World War II. I wasn't alive, maybe a few of you were. Markets initially declined sharply in early 1942, but once the USA's direction became clear, stocks bottomed and rallied strongly. Full-year returns in the first year in 1942 positive to the tune of 19.75% to almost 36.5% each and every year the U.S. was active in World War II from 1942 through 1945. Okay, let's fast forward a bit to the Korean War. Yes, the surprise invasion triggered volatility. Markets recovered quickly as economic activity accelerated. The full-year returns the first year, 30.8%. Okay, we're going to fast forward to my birthday in 1965 in the Vietnam War. It was a gradual buildup, not a one-time shock event. However, strong economic backdrop supported equities that year. The first-year return, 12.4%. Okay, even closer, the Iraq War in 2003. Markets declined leading into the war, but once the conflict began, it certainly dropped. It didn't rise, and stocks rallied sharply. The full-year return in 2003, 28.4% thereabouts. Investors, historically, more often than not, markets bottom near the start of the conflict or soon after the fighting starts, and then begin to recover on peak as uncertainty declines, even if the fighting continues. Why does today feel different? Well, today's concerns are geopolitical conflict, oil volatility, AI disruption, and higher interest rates. It also feels different now because advances in technology has given us up-to-date information at our fingertips almost immediately. You don't have to wait for the newspaper or the nightly news updates. Heck, real-time ship traffic and troop movements are available almost immediately on your phone from posters on X or on Substack. However, investors, the U.S. economy remains resilient, earnings are growing and accelerating, and innovation continues. So, since 2009, as in most years, greater than 5% corrections are frequent, with a median decline of a little over 7.5%. Each correction has a unique narrative, but the pattern is consistent. Markets correct more often than not, recover in advance. Here's a great table from Charlie Biello of the S&P 500's greater than 5% corrections since the end of the Great Financial Crisis in 2009. Included is the reason or rationale many investors gave for not investing in those years. Investors, what are the takeaways? Expect volatility. It's normal. It's the risk you get from investing in stocks, with the reward being trying to have your money grow at a multiple of inflation. Try to avoid reacting emotionally when headlines hit the news. Do what you can to focus on long-term fundamentals in growth industries if that's your style, or focus on consistency and durability of dividend growth if you're a dividend growth investor. Investors, do what you can to recognize opportunities in fear-driven sell-offs. Maybe get on the phone to talk to your advisor about investing more during highly volatile times. First, pulling back or raising cash in a down market. So investors, the next time you hear that this time it's different, pause, look at the data, and remember, in most years, it usually isn't, due to the strength and stability of the U.S. economy and companies that make up the earnings of the S&P 500. Investors, whatever your priority is, growth, income, or a combination of both, the Oak Harvest team is here to help you and your family plan for your financial future, no matter where you're at in your career or in your retirement.